This is episode 64 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 64 of the Andrew Hines Real Estate Investing Podcast. Today, I have a two-part episode. The first part is my interview with Mack Cunningham, who is an investor out of the Ottawa area. Mack is established in multifamily buildings. He's only been at it just a few years, but he's taken the approach of using joint venture partnerships in a really creative way. Normally, we're seeing joint venture partnerships with one money partner and one working partner, but Mack has basically used the opportunity of joint venture partnerships to buy into a building that the owner already owned and just didn't want to deal with anymore in exchange for mentorship and, of course, a piece of the pie. It was good to talk with Mack, good to get a perspective from somebody in the Ottawa area. I'm using this lockdown that we're in to open and spread out my focus of guests and try to get a few more people from across Canada. And so far, it's been really nice. It's been a really great opportunity. So, of course, always trying to look for silver linings where I can. So the second part of the episode after my interview with Mack is a little talk on economics. I've had a few people ask me, and also a friend of mine encouraged me that I should talk to you a little bit about my perspective with economics, where I see things going. Of course, none of this is advice. It's just what I think, and hopefully give you some perspective as to where we might see things go over the next 6 months, over the next year, 2 years, with our economy, with our market. So I'm just going to go into some of the basics of human psychology and how that intertwines with economics and what we might expect to see. Again, just totally opinion based, but I feel that it may be helpful and I thought I might as well share. So that's going to fall at the end of this episode. So stay tuned right after the interview. And as always, I just wanted to ask you to please take a moment and review this podcast on Apple Podcasts, on iTunes, or wherever it is that you're listening. If you're watching on YouTube, please give it a thumbs up. Please share it with somebody that you think it could help, because it's going to help this podcast grow, reach more people, and hopefully help them too. So with that said, let's jump into the episode with Mack Cunningham. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I have Mack Cunningham on the call here. Mack, thanks for taking the time.
Hey, I really appreciate you having me on the show there, Andrew.
Yeah, well, it's we've been texting for a while. It's been probably about a year here and there. We kind of connect on Instagram, and I know we were planning on getting you down this way to do an in-person, but given the current situation, I thought a perfect opportunity to just do it this way. So if you wouldn't mind, you're out of the Ottawa area, if I'm not mistaken.
So I'm investing in Ottawa here. I've been investing for 3 years. I started with, I bought a townhome, and then I renovated that one. I bird that one. I've been living in it. And then I have 10 units as well. So I have a 4-plex and a 6-plex that I'm partnered on. I also did a flip that just closed early this year. So, I've done a couple things. Last year was definitely busier than this year. Mind you, we're only 4 months deep, and I think everyone's keeping busy now with everything going on. So, it's been good. Lots of lessons, a lot of sweat equity too. So,
yeah. Are you the guy that does the work? Like, tell me a little bit about your model. Like, you've got a couple of bigger buildings there, so a 4 and a 6-plex. Those are burrs as well?
Yes and no. So, kind of an interesting approach to those ones. The 4-plex, so I have a couple partners. I am the working partner, yes. However, it's kind of like split tasks. Like we kind of took a year to really develop a partnership, which was definitely one of the things I would tell anyone to do, is get to know your partners. Took a year to develop a partnership, and then what ended up happening was myself and another one of my partners, we bought into the 4-plex, which was my other two partners' building, and we bought in to refinance it, to remortgage it, to buy the 6-plex, to pull the money to essentially close and have the down payment ready for the 6-plex. So,
okay, so same partners on both.
Yeah, for those two, yeah. And it's been interesting so far. There's definitely been some creative things that have come along the way. Definitely been interesting times. We're in the process of doing a couple. We just closed redoing the mortgage on the 4-plex once again. So that was happy to do that.
So, and what was the driver of value? So you mentioned you're refinancing it. What did you do to the building to add value to it that allowed you to get more money?
From a rental point of view, I think your best value adds. I mean, I'm targeting specifically a neighborhood called Vanier, which, depending if you talk to someone from Ottawa, you might get a different reaction. Whoever you talk to, it's got a bit of a stigma and the history. It's changed. However, the nice thing about Vanier is it's where this building is about 2 or 3 blocks from Rockcliffe, which is the most expensive neighborhood in Ottawa. So you have this street called Beechwood, and it is super close. On one side of the street, the property value is almost double. So it's only a matter of time, I think, till development changes, and this property, it kind of comes south towards Vanier. So my whole entire portfolio is invested in Vanier right now, more of a long-term strategy. So back to answer your question there, Andrew, we're restabilizing these buildings right now. This building was already sort of in stabilization. However, we took over, we kind of had an agreement internally that we were going to buy in, kind of last December. And by the time, we have 3 lawyers involved, right, to get it all ironed out, it ended up being closer to the end of February, early March, but we'd had an agreement in place. And so we had a turnover back in December of 2018, and we were able to, go in and we painted it all. The unit was previous. There was a smoker, so you do your TSP on the wall, cleaned it all up. I find that just changing like hardware on the existing kitchen to a satin nickel finish, and then 1 bedroom needed flooring. I mean, I could have done the whole unit, but we're kind of in this more for the long term. So I think there's steps to the upgrades, right? There's a certain try and get your money back within a year or 2 from your increase from what you're spending, right? So
you're just tidying them up then, just tidying
them up, and then bringing the rent up to market, and then as things go along, maybe 4 or 5 years from now, the rental market here is very, very hot. Now, right now, it's obviously interesting times, so who knows? But I know that you do more of like a full gut, and you would go and put in the high-end kitchen, right, and make it look a little more, top of the line. I think Vanier will be there. I think Vanier will be there in 5 to 10 years, right? So I in the back of my mind, I'm tidying them up, and then 5 to 10 years from now, I'll reevaluate where I think if I can boost rents again, type thing, right? So.
Okay, so your initial, so it started with this 4-plex with your partners. You went in, you tidied up 1 unit or 2 units, or did you get all 4 to get the tenants to leave and redo?
No, so actually, I still have 3 of the original tenants that he had. He, I guess, had a problem tenant back before we were partners, right? And he had dealt with that. He had done some interesting things to actually acquire the building. And then we did a 1-year term with the mortgage. And then a year later, we were able to, we did another appraisal, and we ended up painting we redid 1 unit pretty well, paint your fixture, your small fixtures, couple little things, like just cleaned up the washroom, and, like your simple stuff like recaulking the cabinets and stuff like that. And then we had the other 2 units. We actually had one of the tenants volunteered to paint them both. So we supplied the paint, and he painted them all. We ended up paying him because we didn't want to take advantage, right? So, and we came to a win-win agreement, and everyone was happy about that.
So how much did you buy that building for?
I have an interesting kind of agreement for that one. I bought that one, technically we bought it at 700, the 4-plex, 700,000. However, I didn't put anything down. So,
yeah, because you were the working partner. The other guys put the money in.
Well, he had already had equity in the building, and it had a lower evaluation. And then what happened was we just redid the evaluation, and it came up to where we thought it was. But I essentially got a personal loan BTB from my partner. So.
Oh, okay. So your situation there is you found somebody who already owned the building and then partnered in with him so that you could start managing it and fixing it up and taking care of it.
Exactly. And he's taken I have my other working partner, and he's an older gentleman. So we kind of play like a good cop, bad cop game. Me and the younger guy, we're just property managers, right? So, and the older gentleman. We'll refer to him as Old Grumpy because that's what we call him. We tell all the tenants. This is one of the best things I could tell anyone is we tell all the tenants we're just the property manager. You know, he's the landlord. Like, what do you think he's gonna say if you can't pay your rent on time, right? So works pretty good. So myself and the working partner have taken over management of the building as of a year now, and you know, some things have changed, right? We've put in some new procedures, and most of the tenants have enjoyed it, and they're still there. And you know, we have probably more lower income families, but you know what? I'm very thankful right now that I do have these because you know, when you have social assistance, you know, I have my checks coming in still. So in times like these, I'm very thankful that I do have these tenants. I think that's one thing that people hear is they think, oh, someone on social assistance. It's not necessarily, you know, I agree. There are certain people that I would never want to rent to, but I have if you know how to weed through them, you can definitely get some good quality tenants. So
yeah, it's a very, very interesting time right now, right? With the virus right now. I mean, I used to think student rentals are like the most bankable thing ever, but now when school's not on, like everything you thought was up is now down, and everything you thought was for sure is not, and things that you thought for sure not are now being looked at as a good thing. Almost nobody who's applying, I mean, at least recently, almost no one who's applying for my rental to re-rent it even has a job right now. They're just living on the you know, the $2,000 a month because they can't work or what have you. It's such an odd time, and with landlord tenant board closed right now, we all have to be so careful about who we put in.
Oh yeah.
I'm fortunate on the one that I'm re-renting. On the one I'm re-renting, I have the ability to increase rent on it, though. It's not rent controlled, although, I mean, who knows, right? You know, like I said, everything we thought was one way seems to be another right now. So who knows what will happen in the long run. But pick people who have respect. That's for sure, I would say. So on that one, I just want to understand the dynamic a bit more. You found the person, you negotiated a price with him. This is the current value. And then you said, this is the kind of work I want to do, and then we're going to go back and refinance. Is that how that happened?
Well, no. So it's a kind of a funny story. So I'm a Ray member, right? And I was at Acre, if you know the Acre event, and this gentleman was from the Ottawa chapter, if you will, and I'd known him for 2.5 years probably, but I didn't really talk to him a whole lot. And then the day that we were leaving, we were flying out from Toronto to Ottawa on the Sunday, and he offered us a lift and said, hey, and then kind of on the way to the airport, he said, hey, if you're ever interested in buying a multifamily building, let me know. We'll grab a beer. So it kind of, what happened after that is we was kind of like, wow, do we want to go talk to this crazy old guy or whatnot? And, you know, it ended up going for one beer, which led into a second beer, third beer, and ended up being basically us building our agreement, right? And then the sixplex came up, and we kind of looked at ways to do that deal, and in turn, we bought into the rest of the portfolio.
Okay, so was it the sixplex first, and then you bought the fourplex that was already his?
So we actually closed on the fourplex one day before the sixplex.
Just before we continue, I just want to reiterate why I think this is so impressive, because you know, you went to an event, you found a person who had a problem, and you're solving it by being their working partner, picking up 10 units in the process in the course of 2 days. 10 units in 2 days.
And then they're both actually VTBs, so.
Okay, so the sellers on both, well, the seller on the 6 held a VTB.
Was also a VTB as
and
well.
And then on the fourplex, he already owned it, so he just didn't adjust his
mortgage. But he gave me a VTB, and I'd done my own comps, right? And so I kind of had a pretty good idea what I thought the building was worth. But, you know, appraisals, they don't always come in where you think they're going to come in.
Sure.
So we had an appraisal a little lower, but I kind of still knew what I was paying for, I think, in the real world. So obviously, if you get a VTB, usually the offset is maybe you pay a bit more of a premium, right? So
yeah,
I may have paid a little more, but I got favorable financing when I didn't have the money, right? So
you're on title on that property then. So you've effectively bought in. So he offered you a VTB on your portion of the equity. What did he value it at initially?
Well, he valued it at 700, the building, right? However, the bank valued it at 600. And then within a year, like we got it reevaluated. It's worth 725 now.
Okay, and he's still holding the difference. You're still no cash
we
because
have
he's
kind of an
holding.
interesting way of structuring it, but I basically have a personal loan to him.
Okay, you have a personal loan for
I'm paying
one third. Is it one third, one third, one third?
One fourth, one quarter, right? So
okay, so you and your partner each hold a quarter.
Yeah, and then we each have a quarter of the sixplex, and the thought behind this, is we have one silent partner, right, as well, who's we basically made our joint venture so that anything up to let's say $2,000 is maintenance, right? I'm running the operations and maintenance, so any reasonable little thing, just go and fix it. But anything that's a substantial rental, I have to consult everyone, right? So.
Okay. And, I just find this interesting. You're just mentioning about your fourplex, that you have your main partner that owns it, and then you've got your other working partner. And then you mentioned you have another silent partner in there. What's everybody doing? Why so many partners?
The idea too is that together, when you have 4 incomes, you can qualify for a lot more. Once we reposition these buildings, I'm looking to get into something bigger, right? Like 12 or more. When you have 4 people, if it works, they all have to have the same vision. One of them is a silent partner, right? And then, the other one is kind of more or less, he's mentored, right? Like essentially a coach for free, never charged me a cent of coaching. It's mindset, right? It's, can you do it with more partners, right? I think the saying is that it's either you can have a small piece of a grape or a slice of a watermelon. Which would you choose, right? So it depends on what you want, right? And I think if you look at a 20-unit building, right, and you look at the cash flow of a 20-unit building and the pay down over a long time, right, it'll definitely pay down. I think I think in the long scheme it makes sense, right? So the 4-person premise we have is kind of it was set with an expectation that one day myself and my closer working partner would probably maybe go on our own, and this would be kind of like a foundation building block to build off of.
What you're saying makes a lot of sense. I mean, I know it's a building block, and I think that if you can get paid while you're getting educated and have a good mentor in the process, I think there's a lot of value to that. My experience with partners is that, like you said, you got to choose carefully. You got to be very.
Oh, well, we can talk about the flip, but that was the same thing. That was 3 partners, but 3 more partners, but everyone's trying to call the shots, right? It ended up being 2 versus 2, right? Now it is challenging, and that's what happens if you don't vet people and really take the time.
Too many cooks in the kitchen.
Yeah, too many chiefs, not enough Indians, right? So
I've heard that a fair bit, in terms of partnerships and the challenges that come with it, because at the end of the day, like, sometimes it's just easiest to be able to make, call the shots yourself and make decisions. So I know Mark Loeffler, I had him on the show, and he says that you won't even partner with somebody if they have any aspirations of being an active investor, because he wants the silent partner front the money, and he'll be the guy that's doing all the work.
Call the shots. Yeah.
Call the shots. I mean, he doesn't actually physically do the work, but he hires it out. And I think that's the general model that works. But I mean, of course, in the early days, I think like even Stefan Arnio in his book has a story about how their first project, I think he had a couple partners on it. And, that's a lot of people start that way. And it's probably a really good learning experience because no one wants to feel like they're in it alone. When you're early on, and then if you got some financial backing, like to your point, you said you want to buy bigger buildings, and people with deep pockets are going to help with that. They got the down payments, and if you are doing all the work, hopefully your reward is half the cash flow, half the equity or upside anyway, half the upside. For your efforts.
One thing that people can take away from this is that not everyone. It's not all about just money, right? Like. The older gentleman, he's telling me, I've got 5 to 10 years left to live, right? He had some sickness, and he's like, I want to enjoy the rest of my life. I want to watch someone grow, right? So that's his whole reasoning for wanting to partner with myself, right? And he's taught me so much that going into this stabilization that I did, like for the sixplex, like. We're talking about pretty rough neighborhood, right? Like, and some rough tenants, some interesting tenants, so definitely having that person there to be able to call up at any given moment and who's willing to pick up the phone and say, do this, You know what? I went, that would, if I did that alone, it would have taken me 3 years. It took us 8 months and well, it took us over a year now, and we're just starting the refinancing process for the sixplex. So it's, it's how you look at it, right? And for us, it's kind of like, myself, I'm kind of more of probably the more aggressive style investor, as my one closer working partner is very conservative, right? Like an engineer, right? So he very calculated and conservative, right? So reality is somewhere in between the middle, and between the three heads, usually the best outcome will come. Sometimes if we had a problem or something, we'll just kind of react. Like if we had a flood or something, we haven't had that or anything yet. But for dealing with the maintenance and stuff, there's like a mutual respect, and it's kind of open book. So it's been working so far, and down the road, sure, we always have the option to do. It's a flexible joint venture that it'll respect everyone what they want to do. Other aspirations, right? So
Okay, I agree with you totally in that, like taking the opportunity to learn, right? And it's like I went into the mortgage business not because it was the most sexy or lucrative, but it can be, but lucrative, that is. But it was about learning. It was about learning. Right. It was about picking up on things and being a part of the industry. To have somebody, JV, that knows a lot, just doesn't want to do the work anymore. That's powerful, and that's a nice situation that you put yourself in. And of course, you put yourself in that situation because you went out and you went to the meetup, with Rain. We have one similar. Yeah. We have Rain down here, and then we also have Right Club, and I host a meetup.
Yeah, I'm following a couple people that are. I listen to Sarah's podcast too. Right? So
So Sarah has her podcast, and she set up the Right Club with their partners there. So yeah, there's a lot of opportunity to kind of get out there, meet with people. And, people often ask me for like the easy answer, like what, how do you get started, or what do I need to know? And it's like, I couldn't tell you all in one conversation. You couldn't learn in one conversation.
Yeah. No, there's so much to know, right? And like, it's not like an overnight success, like some people might make it look like. Instagram can make it look like that. It's, I look back and it's like, I studied 5 years ago. I remember my first book that I kind of got into was Cash Flow for Life, which was Scott McGilvery's. And that one, it's a lot about student rentals actually, right? So, and that one kind of was what kind of started making me click, and I read it and kind of actually read it like a second time and took a couple notes, and then it was from there. It said, you got to build your team. I went out and met a couple people and kind of started figuring it out. And then I got very lucky. Like I ended up buying my place, like my principal residence is townhome where I am now. And I got lucky because I got in right before the stress test. And just, it's funny how things kind of work. It's funny because I look back and I actually wrote off a car. I ended up getting the offer accepted on July 1st on Canada Day. And it was like end of May, I totaled my brand new Toyota Corolla. It was the best thing I ever did, because that $300 a month payment ended up being the difference between me getting the mortgage and not. And plus my insurance went down the year after because I turned 25. So kind of got lucky there.
So there was a silver lining there. Yeah,
exactly.
So you've had your townhouse that you live in for 3 years then?
Yeah. So this was my first project that I undertook, and I definitely threw myself into the fire, if you will. Okay. I come from a construction background, so I work in HVAC full time in commercial. I'm a sheet metal worker by trade. So I bought an electric baseboard heated house, and I brought the gas service in, and I converted it all to all natural gas appliances, everything I could do, right? So I bought it. I got lucky that I kind of bought at the right time, and I definitely bought at the right price because I had a good agent. And it's interesting to see how much things can change in 3 years. So
yeah, how is your market done up there? Like, what have you seen? Have you seen significant growth in values just from appreciation?
Absolutely. I think that I definitely got in at the right time. A lot of things happened between then and there, but obviously Ottawa is probably one of the hottest in the country right now, I think, for real estate investment. So there's a lot of people. I find a lot of people coming from Toronto, or just Toronto's gotten so expensive. So I've seen, at least when I put out my rental ads, a lot of people moving here from Toronto, a lot of people from all over, just because it's so expensive in all these other major core cities throughout Canada, right? Like Vancouver, Toronto, Montreal, right?
So Ottawa is really just catching up price point wise. Like, what's a bungalow cost? A 1,200 square foot bungalow in an average neighborhood in Ottawa. What's that
you
cost?
can't buy anything under $500,000 anymore. It doesn't seem,
Okay.
unless you're buying privately. So
getting to be Hamilton-esque type prices then.
yeah, I would say pretty comparable to Hamilton. So.
Okay. And, for those who aren't familiar with Ottawa, it's capital city of Canada. Obviously, lots of government work there. What other kind of industries have you noticed there that kind of really make that a safe and sound type of industry or town to invest in?
Well, we're actually, from what I've been told, we're like one of the tech, I think we're one of the tech hubs of like North America. Like, I've been told that we actually have, I don't know if we're the second to, like, you'll have to Google this and verify the info yourself, but I'm pretty sure we're like second in North America for tech jobs. So Canada is just bustling with that stuff. You've got a lot of government. We've got Shopify that started here, and you do have, because you have so much development kind of starting, you got a lot of site plan applications everywhere. So lots of construction jobs, and the government would be the main influence. I'd say about 40% of the jobs here are probably government, and they're not going anywhere. I would say, like, a big impact. The biggest impact on real estate values here is whether it's the liberals or conservatives that end up getting it, because that changes the spending habits of the city. So.
Really? Yeah, please explain. So you see less spending if the conservatives are in?
Yeah, you'll see job cuts, right? So like, in the last time the conservatives came in, I believe there was some job cuts on the federal level, which, when you lose jobs, there's some uncertainty, and not as many people are necessarily buying, right?
Okay.
Whereas you've got like the liberal government now spending lots of money. A lot of people are feeling confidence, right? So everyone's out here trying to buy, and it was crazy. The last 2 weeks, last month, I should say, everything is just kind of plateaued, and but up until now, it's just been bidding war, cash offer. I'm sure you know what that's like.
Yeah, well, that is the scene that is Canada right now. All major cities, really in Ontario across the board, anything in the south end, and from what I understand, even like Sudbury is seeing that kind of thing. Well, not to that degree, but they're also seeing a pickup in their values too. We've got so much foreign investment in our real estate, so much immigration up to prior virus and lockdown. It's really driven real estate out of the reach of most Canadians, and I've talked about this a lot on the podcast. If you've ever followed me, you probably heard me talk about that. That we're eroding our middle class, and this event, this thing that's happening right now, is devastating, and is going to probably create a lot more of a divide between the wealthy and the poor, unless something changes. So we'll have to see. But I mean, on your point about Ottawa, I think that it's generally, when you're government backed, that's traditionally seen as being extremely stable, right? If government is a big portion of your jobs, you said, it doesn't seem like it's going anywhere, but I also didn't think school was going anywhere either. So,
well, it's, it's another thing too, you got to remember too, is we're right on the border between Quebec, right? So a lot of people think Ottawa, 1 million people, but you look at Ottawa Gatineau, you're 1.5 million, right? So.
Yeah, there's a lot of people there, and tourism's a big thing. It's obviously a place that people go to visit. There's so many reasons that make it a pretty diverse town. Which
a lot of parks. It's still a very beautiful city. Good schools. That's probably one of the main drivers too.
Yeah, so that's the type of city that I would invest in student rentals in. Like, that's like a perfect example of a city that I would like to invest in student rentals in. Because even if student rentals don't become the thing one day, or school is a less popular route, like Gary Vaynerchuk gets his way and everybody learns on YouTube. If school becomes less popular, then there's still a fallback. There's still other uses in that city for that real estate. So
we actually have certain neighborhoods that have pretty well been like completely almost converted into like student housing. There's this thing called the infill amendment. So we have a neighborhood called Sandy Hill, which is right near Ottawa U, and there used to be, I guess, a loophole with building permits, and you could go in and you could buy a house, and they're all like 50 by 100 lots, right? So you bought the house and you could just pull a permit and basically add a triplex on the back of the house, right? So one or two of these developers figured this out. They'd go in, they'd buy the house, keep the existing house, add a triplex on the back.
Like
and
3 extra units.
3 extra units, and then they would add in like as many bedrooms as physically possible, and they would like charge like $700 a room. So these guys figured this out, this loophole, and then one of them, I know they even like sold them to investors and then would manage them, and they build them cheap so that they would break and they would fix them, and they obviously it exploded. They took off and basically changed the whole landscape of neighborhood. So if you drive through Sandy Hill, you would see all these buildings that this is exactly what happened, all student housing. And they even have, when they have the Panda game, the whole street's closed off. There's garbage everywhere. It's pretty crazy.
It's crazy how one person or one small group of people can do that. And I've seen the similar in London, like almost exactly what you just described. I saw a guy do that. He learned that you could rip down houses and build brand new purpose-built duplexes, 10 bedrooms in total. He was, buying the houses for 180, building for one or 250. And then he was, selling them for 600. And so he was making a good buck on them. And he did that for as long as the bylaw would allow. The bylaw changed, and then he figured out the next thing to do. And he systematically transformed neighborhoods. And I just followed him from the beginning and eventually learned how to do what he did. And that was really my start, into student rentals, was watching him and watching what he was doing, creating value, and exploiting something in the system that was out of people's radar, that wasn't really on the general public's radar, and just tackling it. And I can't say enough about that strategy. If you can find something, a little loophole that people don't know about, and you can exploit it, you can generate massive wealth by doing that. So it sounds like that's what this guy did.
Yeah, there's like one or two companies that did it, and I don't think the city or a couple councillors were too pleased with that. But if it's not them, it's the next person, right? So
oh yeah, you gotta. Can't please
everyone.
This is how zoning changes happen, right? Like I've told the story here. Like things I've done have actually ended up with zoning changes being made. So you might be the catalyst, but as long as the opportunity's there, take it. But also know if you're trying to do or exploit a certain loophole, and all your eggs are in that basket, if they change the law, what happens to you? You got to be prepared. And some of that might come down to getting your permits in before you firm up. Like if you're really concerned, or if the property only works one way and you don't have a plan B and C, then that's pretty dangerous. So you obviously gotta watch yourself.
You gotta hedge your bets for sure. I definitely agree with that.
So Mac, I did want to transition a little bit. So we got to have a good feel. You've really focused on the education, partner multiple ways. Do you mind sharing what kind of cash flow you can get on those properties up there? Like what does that 4-plex cash flow? What does the 6-plex?
So that would be probably part of the whole four partner thing, right? If you're going into a deal like that, whether it be the 4, let's call it the 4 and the 6, right? When we started, right, we had 2 VTBs. We're relatively leveraged, right? So if you had to have that whole burden, we're probably negative. I think between the 2 buildings when we first started, we were negative cash flow probably $1,200 over the two buildings, right? So, we'll try, and when we kind of get in, we'll try and take our time and like just outlast, right, if you will. Like how do I say this probably? I would not spend as much right away, right? And when you get the opportunity, you can spend it and rehab, right? And then basically, the big game changer is when you're dropping the interest rates. So because we're going from one mortgage, because we had a VTB,
so better take back mortgage. Okay, so you had 2 mortgages.
And then we had our.
Do you have cash flow now? Do you have cash flow now on those buildings?
We'd be between, now technically we'd be up probably 600 on the one building because we just redid that mortgage, and then we're doing the other mortgage, and that's going to bring it up 1,700.
So you're going to have, you'll have over $2,000 in cash flow between the 2?
Yeah.
And this is split between the 4 partners?
Yes.
Yeah. Okay. So you're getting paid to basically educate yourself, learn all the dynamics of joint ventures. When you look now, and I'm going to ask you how the whole virus thing has affected things for you, but when you look now and you look to the future, how do you want to proceed? Where do you see yourself in 10 years as a real estate investor?
You know what? I definitely believe part of Matt Piche's philosophy, right? To invest right in one neighborhood, or invest in one city that you know. And I think that a lot of people are fearful of Vanier, and I think there's a good opportunity here. And I'll tell you why. It's because right now we have in Ottawa we have it's probably the biggest, most opposed development that's ever happened in the city of Ottawa is they're proposing putting a shelter on Montreal Road, which obviously is not good. And the funny thing is, if you read the bylaws, it says no shelters on traditional Main Street, but the city of Ottawa has basically given it a kind of a go ahead. So, out of all developments that have ever been submitted through site plan, this one's gotten the most opposition out of everything. And anyway, you can Google SOS Vanier and read about it if you want. But with this, it's kind of it's kind of holding a lot of people back from this neighborhood, I think. And my reason for not being too worried is I'm not buying right near this shelter.
Mhm.
And I think that I think that Scott McGilvery says it the best is love the numbers, not the house, right? I try not to get too emotionally attached when I'm running my numbers, right? Or when I'm putting in an offer. I try and really take a step back and breathe and see what's going to work for me, right? So I think the shelter would be more of an emotional driver. If you actually did the research, which I did a bit of research, and it says that, I don't think it is so dependent on what it is being a shelter. I think the fact that it's a brand new building compared to the old crummy hotel that's there, I think you're going to see some value gain just from that. And, to give you an idea, Montreal Road right now, they're doing a whole revitalization project where they're basically ripping up the whole street, redoing all the infrastructure. So there's like $50 million project going on Montreal Road to basically increase services so they can put up condos and stuff right here.
Yeah.
So
it'll be
when
offset.
I think when you see the infrastructure going in, that's a good sign, right? When the shovel hits the ground, that's where you should be buying. So I see myself hopefully buying a couple more buildings in Vanier. Hopefully I find that the good tenants are the people that are coming from Toronto that don't know the history of Vanier, right? So those are the people I'd love to target, is the people that are coming here for those contract jobs with the government that they come to the neighborhood and like, oh, it's still cheaper than everywhere else in Ottawa, and I'm super close to downtown. Like I'm right east of, I'm an 8-minute Uber ride, or $8 and a 5-minute Uber ride to the Byward Market, which is right downtown, or where all the nightlife is in Ottawa, right?
Yeah.
So it's about as close as it gets without being, it's still I'd still say a deal. So
yeah.
So I see myself still here. I'll be in Ottawa as an investor. I'd like to get more to the full-time investor.
Okay.
I'd like to become more of do a couple more active deals where I can be actively investing and be a working partner and get paid to be a working partner. And then, maybe I have some money partners, right? So we're buying a bigger building, doing some stabilization. Like I am a contractor as well. So I do
a general contractor as well?
Yeah, I'm a general.
Okay.
Well, so I work full time. I'm a general contractor. I've done my Carry-On courses, so I do have some education behind me. I spent some money on self-education, right? So I haven't registered to be a Carry-On home builder, but I got to open a corporation, and have an interview. I'm not too concerned, but I've done all the courses, right? So
okay. So you're right in. I mean, that's obviously what makes you really, really prime for being a working partner, is you understand the trades, you understand renovations. You probably are able to do a lot of the work yourself.
Yeah,
anything that needs to be done.
Funny. We're at home right now, and I'm right in the middle of it, right? So
yeah.
If I'm going to be quarantined, I'm going to take advantage of the time. So
yeah. So are you still working right now, or is all your work pretty much dried out?
I am still working right now. Multi-unit construction is an essential service, so I'm still. We've gone down to Monday to Thursday, which I'm really not. I don't mind it, because I'm here the other 3 days, so got an extra day a week to work. But the problem I foresee, if they're going to stop construction, is 8 months from now, all these big jobs that aren't out of the ground, it's going to really cause some friction. So I hope they get the permits back open.
Yeah, that's it's not a good thing. It's not a good thing. Well, none of this is. This shutdown is a very, very tragic economic event, and I'm really hoping that we see a turn to this very soon. Because under our current system, it just wasn't built to withstand this, the economic system. So that's a separate rant. We won't.
We could go on for hours. But
yeah,
I definitely agree that I think there's if you were to have Canada's economy in a bucket, I think the pin drop in the bucket would be COVID-19. And I don't think this is good for us. So if it's everything's going to tank, it means in theory, prices should go down. But I still think Ottawa's rental market, where it is, it's still, I don't think we have an affordable housing crisis in Ontario.
Oh yeah.
I don't think if you got these long-term investments, if you got buildings, I still think long-term people will always need a place to live, right? And if you're going to buy for long-term, you're not going to lose. You just got to weather the storm. So.
Well said. And I say that all the time. It's the weather in the storm. How long is that storm? We don't know. So, I mean, I always look at, if I'm going to buy something now, it's got to be, I'm comfortable keeping it for 20 years plus. That to me is a must, because we just don't know how this will play out. We really couldn't possibly know. I think it has the makings of something that could be worse than the economic impact of the Great Depression. But we also have far more advanced economic policy that will combat that. So, time will tell.
You
of
and
course.
Me both, right?
Yeah.
So,
well, time will tell, and there's so many decisions to be made, right? Political decisions about when we restart the economy. But we'll see how this all plays out. So, Mac, if you had one thing that you've learned that you would want to share. What's like the most important single lesson you would want to share with somebody who's in the earlier stages? Maybe they've done a JV, or maybe they're thinking about doing one. What would you tell them?
You know what? My best piece of advice would be to anyone starting out would be to learn how to do your taxes, learn how RSPs work, because that's how I got my down payment. I because I was an apprentice for 5 years. We have the way the pay system works for an apprentice is every year you go up an extra 10%, 10%, 10%. So, I took that extra 10% and I started over the year just dumping an extra couple $100 in my RSPs, right? And in a 3 or 4 year time frame, I took that money and it ended up being my down payment, right? You have the first time home buyers plan, right? So I took that money. I even took an Ontario Youth Apprenticeship Program, which is an interest-free loan while you're an apprentice. And I put that into my RSP. And then I essentially rolled it all in. And when I did my first mortgage, I did a Purchase Plus, did all the work myself and paid it off. So the RSPs, I turned 10 grand into 23. I probably put 10,000, maybe 12,000 of my own money, because I played stocks for 3-5 years. I turned it into 23, which was a down payment, right? So I would tell anyone, buy 5% down. It's better than than waiting for 20. But I think, if you can learn how to use your RSPs, that's a tool that if you haven't bought a house yet, you can make 18 to 20% to do nothing, right? So if you go to the bank manager and do your taxes before the 60th day of the calendar year.
Okay, so you're saying you make 18 to 20%. How is that? Because you're avoiding taxes?
Yeah.
Okay.
You're deferring it, right?
Yeah. So you're deferring your taxes. You're going to use that money that you've put into your RSP for down payment. And I've seen a lot of that, coming from the mortgage business. I've seen a lot of people do that, and it's a great opportunity. I think just getting back to your point, it's better to buy at 5% than 20. Generally speaking, I'd say yes, that's true. The only caveat I would say is, make sure you got the cash flow, because that 5% equity might go away depending on what the market does. We've been so blessed in so many ways to get our values of real estate shooting up, like crazy, making us all look, look like geniuses. Absolutely. It's been making us look like geniuses, but this will be the true test potentially if we do see a correction to see who can weather the storm. And the better you prepare yourself, the better you put yourself in the position to weather that storm. Obviously, the more likely you are to come out on the other end of it, still a happy real estate investor ready to do more. But Absolutely. A lot of people are going to take advantage of this, right, Mac? If you see prices come down, it might even entice you to want to do a couple more deals, because now you got a better opportunity.
Absolutely, absolutely. I mean, I'm taking the opportunity. I'm redoing both my mortgages so I can have, have the cash sitting in the pockets, right? So we can. I even, my RSPs, I have that still, and I'm playing with the stocks. I'm buying gold and silver companies, right? I think that's recession. In times of recession, that's a good thing to be looking at.
Yeah.
And then, yeah, like I said, I'm hoping that maybe once I get them all done, I'll be able to hopefully go out and buy another building for sure.
Yeah, and the opportunity might just come around, right? We get that correction if we do, and then see some prices drop, and or maybe you just make a couple of offers that are lower, knowing that sellers are just kind of looking to get out, and who knows? But as long as we keep our eyes open as investors, we've got an opportunity.
I think the biggest opportunity is you don't have the same bidding war. You got a lot of people scared, right? So if you know what you're doing, you know your numbers, you know what you know the game. I mean,
Yeah.
you gotta play your cards, right? So if you don't have 10 other players at the table, it's a lot more room for negotiating. So
Yeah, like that's the biggest thing I've heard here is that, now you get the opportunity to tie a place up conditionally. Like for the longest time, it was just bidding wars of firm offers. And now you can write a conditional
yeah,
offer and go see it and inspect it and then negotiate. That's an entirely different ball game. So yeah, there's always a silver lining, and I'm sure that there's plenty that we can make here. So just before we go, Mac, if when you're not doing real estate, you're not working in HVAC and general contracting, what are you doing for fun?
I like to ski in the winter. Definitely like to ski, go up to the cottage, like to travel. I've been over to Asia. I would definitely go back. I would like to do, I had plans to hopefully go traveling some more, at the end of the year this year. Who knows? I haven't booked a flight yet, but maybe the prices on those flights will go down too. But
Yeah.
we'll wait and see, kind of take it week by week. And but I would like to. I'd like to go and travel. I want to check out Costa Rica. That's the next one on my list.
That's a beautiful place. I've been there. Yeah, well worthwhile. So, yeah, we'll wait until the travel restrictions are lifted and the airlines are flying again. But
Yeah, exactly.
looking forward to that. Anyways, Mac, I really appreciate it. Where should people reach you if they want to connect?
The easiest thing would be probably either Facebook, just Mack Cunningham, or Mac at intuitiveinvestment.ca is my email. A little bit of a mouthful, but that's probably the easiest.
Okay, so Mack Cunningham on Facebook or Mac at Intuitive Investment.
Intuitiveinvestment.ca. So
Okay.
we are on Instagram. I am on Instagram too, but my page is definitely lacking a bit. I need to delegate that task.
Fair enough. Yeah, I know I have a few tasks like that myself. Okay, Mac, I really appreciate the time, and we'll look forward to seeing what you do next. All right, that wraps it up for the episode with Mack Cunningham. I hope you enjoyed that. I wanted to really just start off this talk, and it's going to be a little bit more casual, a little bit more relaxed than my normal monologues, which are very to the point and right into the episode. So first off, you'll recall that Mac said in that episode that he was investing in gold and silver stocks. And I thought that was very well timed for this talk because I'm going to get into talking about currencies. So let's just kind of dissect what's going on at the moment. As of right now, we're into the start of May. The country shut down back in mid-March. And at the time, I was super concerned about that because I know that our economy has never had more debt. We're looking at people on an individual basis. We're looking at our government. And the challenge with debt is you got to keep moving in order to be able to service it. So as soon as the government said we're going to stop everybody from working, here I am in my head thinking, how are all these business owners with mortgages going to pay their mortgage payments? And yes, the government has done some stuff, but certainly has not taken care of the burden completely. It's really just been a Band-Aid on a gunshot wound for a lot of people. So let's get into what we are seeing right now in the market. We've seen our government announce a $180 billion deficit for this year alone, when if you look at our interest-bearing debt on our country's balance sheet federally was just over $1 trillion. And of course, they have some assets. So people say our debt's around $750 billion. Well, we're talking about adding $180 billion in deficit just in 1 year. That estimate has now been grossed up to $250 billion. And then, of course, if they're saying 250, that really probably means 350, maybe even we go up to 500 billion. So we're talking about adding on a third of our existing national debt, which is all interest bearing, into the mix. So if you think about that, that means the interest that we pay right now, which was approximately $20 billion a year spread across our citizens here in Canada at the federal level. We're going to be adding to that, which presents a burden because we want our economy to grow. But it's, if you can picture a speedboat with an anchor out the back, when you've got your gas on full, but you've got an anchor out the back, you really just can't go that fast. And that's what taxation does to an economy. It kind of slows it down. So this is a good time to get into the psychology of what's going to happen on the other side of this. So if you think about the fact that right now we've got a whole bunch of businesses that are going out of business. Basically, they've been given some government incentive, but it's not enough. There's already been tons of restaurants that have been open for 20, 30 years that says, hey, we're done. We're not coming back. So now all those people are laying off employees. Then we've also got businesses that are going to default on their leases and their loans. Now, whether they're defaulting on their leases or defaulting on their loans, the landlord or the bank is going to pay. In either way, the bank is going to pay, because if it's the landlord that can't pay, now the landlord's going to default on their loans. So what happens when we have all this unemployment and we have all these loans defaulting is that everybody tightens up their spending. Now, you might remember from a previous episode that I talked about what is GDP, gross domestic product. That's how we measure our economy. That's how we measure economic growth. In times of growth, we're seeing our GDP go up every year. And what gross domestic product is just the sum total of all transactions in our economy. So every bag of potato chips, every beer, every computer, every car, every piece of real estate sold in our economy in that year equates to our GDP for that year. So what we like to see is a growing economy. Under our current economic model, that's what we like to see. If we're not seeing if we don't see that number going up every year, then we say we're in a recession. So if we have 2 consistent quarters where that number isn't going up, that's a recession. So what we're in right now is a recession. There's no two ways about it. There's absolutely no way that we're not. That's just a reality. And that's obviously inflicted by our government because they're responding to this virus threat. So knowing that, we're going to come out of this, but we're not just going to resume. So now all these businesses that have gone bankrupt and have closed their doors, have laid off their employees and defaulted on their mortgages, defaulted on their leases, we have that condensing effect. So now every single person who just lost a whole bunch of money, they're not spending. Every single person's like, whoa, I just lost my job, or I just lost my business. How am I going to retire? What am I going to do? They just stop spending. So everybody contracts. And if you think back to what GDP is, it's the sum total of all transactions. So if no one's spending, GDP is falling like a rock. Well, what's the problem with that? The problem with that is we have our tax base. Our government taxes us based on our GDP. They tax us based on our income, which is ultimately the sum total up to our GDP. Well, now they're taxing less and less, which means our government's going to go even more and more in debt. And when that happens, now they're going to have to tax us even more in the future to make up for these deficits that we're going to have. So it's just a spiraling problem. And what our government will typically try and do is they'll just print more money. And I say that as a figure of speech. They're not really necessarily just printing it, but basically they'll take out more government debt. And to counteract this spiraling effect of no one having work, no one doing anything, they'll start throwing money at people. So whether it be through municipal projects like infrastructure, building new roads, building new bridges, things that create jobs, and they'll try and stimulate the economy. They'll keep our interest rates really low. They'll do a whole bunch of things that encourage spending. And when that doesn't work, they'll probably give us what we call helicopter money, where they basically just drop money on us for no reason. And they can call it a number of different things. They might call it a benefit, a special one-time gift, whatever it is, or maybe they'll call it universal basic income, which I really hope doesn't happen, but it is possible. Okay, so what's the problem with all these incentives? Well, this triggers something called inflation. And I've talked about this before too. And inflation is simply your dollar's buying power going down. In other words, it's the price of everything else going up. And it's because there's the perceived value of our dollar is worth less. And why would our dollar be worth less? Well, if you think about economics, I'm sure you've heard the expression, it's all about supply and demand. Well, if we've got more dollars, but no more goods, then we're naturally going to see higher prices. And this is what's happening right now. Right now, we have a society with disrupted supply chains. We're seeing it in all kinds of areas. I'm sure you've gone to a grocery store and you've seen empty shelves. You've seen not enough toilet paper, what have you. I mean, obviously, that's more of a demand problem, but we are seeing some disruptions already. And as time progresses, the more and more people are not working, this problem gets worse. But regardless, we're having more and more dollars of demand without more and and more supply. And what's going to happen, because all these extra dollars are just being thrown into our economy, we're going to naturally see prices rise. How much they'll rise, that's the part that's very difficult to figure out. So what do I think is going to happen in the short term here? I think we're going to see that contraction. I think that we're going to see, depending on how long this goes on, we might see some baby boomers lose their pensions, some retirees losing what they had thought that they were going to be able to retire on. And that's really going to compound that lack of spending, that saving mentality. And that saving mentality is not good for economic growth, even though that you'd think saving is good, but it doesn't help our economic growth. If that happens, ultimately, they're just going to keep throwing more and more money, and then we hit that tipping point. And that tipping point is where we might actually see what's called hyperinflation, which is just inflation at a very high level. And that's when, you might go to you've heard those old stories back after World War I in Germany, where people would have to take a wheelbarrow full of money to go buy a loaf of bread. People are getting an employment raise in wage on a daily basis because the dollar is just losing value so much. That's absolute chaos to me. In my mind, that's probably the worst possible outcome we could see of all of this. And I don't say this to be doom and gloom. I just want to convey how I see this working out so that we can start putting our heads together and hopefully be part of the positive change. But very worst, we can just take advantage of the opportunity and prepare ourselves for it. So knowing that we might hit that hyperinflation, the money that's circulating is going to most likely, and this is totally just my opinion, inflate food first. All of our essential goods, the things we always buy that we're all demanding equally, now we just have more dollars. So naturally, those are going to go up. We're going to see prices of food and maybe even gasoline, although oil prices are way down. But just other essential goods that we need to get probably go up in the short term, maybe in the next 6 to 12 months. No one knows the exact timing of this, and it really does depend on what our government does. So these are just my thoughts. But what does that do to assets? Well, you got to bring it back to human psychology. If I've just lost everything, if I've just, had to have my house foreclosed on because I couldn't pay the mortgage or what have you, I'm not going to be buying houses. Or if I just lost my job and I'm scraping together to pay my mortgage, I'm not really probably thinking about upgrading to a new house, probably not going to be making any moves in the real estate market. So with less buyers looking to buy, that puts us in a position where we're probably going to see more of a buyer's market. They call it a buyer's market because the buyer is calling the shots. The buyer kind of gets their pick. So if it's more of a buyer's market, that means we're probably going to see, again, bringing it back to supply and demand, there's the same supply of real estate potentially trying to sell, but there's less buyers interested in changing transactions and buying houses. Might be something that we see. Or we might not see it changed at all. Real estate could stay the same. I think that we're probably going to see real estate contract at least a bit, and then it's probably going to sit. And what I think is that in the long run, once we see enough economic easing, once the government throws enough money at us that we basically just, can't resist. They're like, holy crap, we just got $100,000 or whatever number it takes for that person that was so scared to spend, whatever number it takes before they stop saving and they say, okay, now I finally got enough. Now I'm finally going to spend. And they go out and try and buy a house, and they go out and they buy a boat or whatever else. That's when we start seeing that tidal wave of money hitting the economy. And that's where we'll probably see some pretty significant inflation. I don't know how much. Typically here in Canada, we've targeted a 2% inflation rate, and they track that through the consumer price index. So if you've ever heard of that, they're kind of tracking, and they say we're right around 2%, and it fluctuates a little bit on a yearly basis. I don't totally agree with the number they come up with, and I'm sure you'll agree that the price of the goods you use on a daily basis have been going up more than 2% a year over the last 10, 12 years. But that is the data that they're reporting. And, I just think here in Ontario, we're not really representative of that number as much as other areas are. At the end of the day, we don't really know what's going to happen. When I look at real estate prices, I say, well, they're extremely out of reach for most people anyway. So when they find themselves in a pretty tough situation and they're, maybe lost their job, they're probably just going to be thinking, yeah, save money. And I don't want to go buy overpriced real estate. They might move to cheaper areas. So we might naturally see a contraction in value in the higher priced areas, and then we might even see values pushed up in the lower priced areas. It's very tough to say anything for sure. We can only really speculate, which is why economists are really just guessing, just like all of us. But my hope with all this is just to kind of give you an indication of some of the fundamentals that go into it. Now, the next part of the conversation I wanted to get into is about currency. You may have heard the expression, the term, fractional reserve lending. And basically what this is what the banks in Canada, the banks in America do, and pretty well any country with a central banking system, is say the bank has $100. The bank is required to keep only 10% of that on deposit. So say customer A came in, deposited $100. The bank can now take that $100 and they leave $10 in the account and they can lend out $90. And then sure enough, that $90 goes out and it circulates in the economy. Somebody buys, a couple of, grocery items. That money now makes its way back. The grocer comes back and deposits the money into the bank, and they have that $90 back there. So now the bank can lend out 90% of that. So they're going to lend out $81, and then that money's going to cycle around and go out and out. So this is called the theory of money creation. And basically the idea is that a $100 deposit is essentially creating nearly $1,000 in money. It's creating money out of debt. It's fictitious. The money doesn't really exist in the bank, but because of this fractional reserve lending, they can create money. And it's money out of nothing. Like, if you really think about it, what is money? Money is supposed to be a store of value. So I should call this currency, because currency does not necessarily need to be a store of value. Our dollar used to be backed by gold, meaning that you could actually exchange a dollar for a certain amount of gold. In the States, they had a policy so you could exchange the dollar bill for, you could exchange $35 for an ounce of gold. I don't remember the exact date on that, but that was the conversion at one point. So basically, once we went off the gold standard, we're no longer there. Our money became worth less, really. The only reason we believe it's worth anything is because the government tells us to do it. So now back to our fractional reserve lending, it's not real money. It doesn't really exist. It's a fictitious made up number on a computer screen that's sent out into our economy. But because of that effect, if you think about the cycle needed to create that money. So one person spends, the money circulates, comes back to the bank, it goes out again, the money circulates, comes back to the bank, and we've created $1,000 out of $100. The second the economy stops growing and people contract, now everyone starts defaulting on their loans. So it comes crumbling down. That is the real challenge with fractional reserve lending, is as soon as we stop growing, as soon as we go into a recession, the whole system breaks. And this is why our central banks, our Bank of Canada and the Federal Reserve in the US, try so hard to prevent an economic crash. This is what they did back in 2008 when they threw all that money at the mortgage crisis, and they bailed out banks and they bought up asset-backed securities. They basically were just buying their way out by printing money, buying their way out of the crisis, because they need the system to continue to grow, whether that's through inflation or whether it's through actual economic growth, meaning more people are adding value. They want it to grow, and we need it to grow. As long as we're operating on this system, we need it to grow. So knowing that, and knowing that that's where economic policy is sort of coming from, and why central banks will always try and stimulate, they'll lower interest rates, they'll try and encourage you to borrow money. They might even actually back your loan. So I see that coming in Canada. I highly suspect that they're going to basically start guaranteeing loans for the banks, so that the banks will still give loans to Canadians, even if they probably shouldn't have them, or under normal policies wouldn't have them, all in the interest of stimulating our economic growth. Another point I wanted to come up with here is that you can't create money. You can only create currency, as we said before. And this is why this whole basic income concept doesn't work. Because if you think about an economy, the only way we can really create value in an economy is if people are actually providing goods and services, things that are actually valuable. There is no way to create money. You can create currency, but currency is worthless. Currency is just a number on a piece of paper. And as soon as we have more of those pieces of paper, we value each one of them less. Therefore, each one of them will buy much less in the grocery store or in the car dealership or wherever it is you're trying to spend that money. So we really do need to understand that our system only works if people are creating value for each other. That's the only thing that can protect the value of our currency. This whole thing where the government sends you a check for money that you didn't work for, and there's so many people sitting at home, and I feel for you. I know we're all in the same position, that we're being restricted in what we can do. I'm fortunate enough that I'm still able to work, but our system only works if people are continuing to create value for each other. Otherwise, every single day that passes, we are destroying our currency. And the biggest concern I have out of all of this, now that you know the logic behind the thinking, the biggest concern I have is What happens when people no longer respect our currency? If it gets to that point where we need to give employees a raise every single week because our dollar is so unstable, do people still buy houses? Are banks still interested in giving loans? What kind of interest rates are they going to charge? So typically what a central bank will do to try and combat inflation is they'll raise interest rates. And they'll slow the economy. They'll slow the inflation. So we saw this back in the 1980s. We saw interest rates go up to 20%. My mom got a mortgage renewal offer at 20%, and she sold her house instead. At that point, when we're trying to buy food, when we're trying to import the goods, we're here in Canada, it's cold most of the year, so we can't really grow all the food that we need here. We have to import. What happens when we can't import food? Because people don't trust the value of our dollar. They say, hey, this shipment would be $20,000, but by the time it gets there, we probably need to charge you 40. So you know what? We're not going to do that. That's going to create problems for us. If we allow it to happen, that creates problems for us. And this is why I've been so adamant that we need to get back to work, because what would happen if we had empty grocery stores, if we actually had famine here in Canada? And again, not trying to be doom and gloom, guys. I just think it's really important that we understand the potentials here. And they really should teach economics at a very basic level in schools. And that's why I just figured, I'm going to do a basic, very off the cuff, unscripted discussion of where some of my concerns are and why I think it's so important that we get back to work. I do think we're over leveraged as Canadians. I think that the system is set up to cause us to use a lot of debt. It's never been easier to get credit cards, to get mortgages, things like that. Yes, these are tools. Yes, they've been incredibly useful for us, but the risk that comes with that is exactly what's happening now. If there's a disruption in the economy, now we have to buckle down and hopefully we can weather the storm. So did I see this coming? Absolutely not. Do I want to see things rebound? Absolutely, I do. So my guest that I just had on the show, Mac, he was talking about buying gold and silver. So why do people do that? So we talked about the dollar being backed by gold originally. There was no inflation when the dollar was backed by gold because gold held its value. The reason people backed the dollar with gold is because gold is useful. It can be used for jewelry. It can be used in electronics. It's scarce. It only has a certain amount of quantity on this planet. And it's pretty much universally respected in all countries. That's something really, really special, really, really useful, and which is why so many countries have relied on gold. And if you look back, even in the US Constitution, it says all their transactions must happen in either gold or silver, and even if it's paper, it still needs to be backed by gold or silver. And that they knew way back at the formation of the country what could happen if they allowed central banking in. I hope that you found some value out of all this. I don't often do episodes like this. It's been the last time I did a monologue was, I think, episode 1. So I apologize, out of practice apparently. I love natural discussions, which is why dialogues are kind of my preference. But again, let me know what you think. Let me know if you have thoughts or other things you'd like me to talk about, or if you disagree with something I've said, or you feel there's another way that we can look at it. I'm totally open to that. Really, this is just about me throwing out some ideas, seeing what you think, and then of course seeing if that's useful to you. I do also want to stress that now that I mentioned episode 1, it'd be a great idea if you're new and if you're trying to learn more about real estate investing, you want to hone your skills, go back to the first 10 episodes, first 15 episodes. I really dug into the numbers. Even on YouTube, I actually posted the numbers so you could see them on the screen. This podcast has had a chronology. We've constantly moved forward, and I focus less on the basic numbers now than I used to, just because it's the natural evolution of things, and I like to focus energy and attention on new concepts more and more. So I would highly recommend, if you're really just trying to get down the numbers, go right back to the beginning. And of course, like I said, there's the chronology. Enjoy it, use it. That's what it's there for. And most importantly, if you wouldn't mind sharing it with a friend or family member so that it can help them as well, I would certainly appreciate it. Again, smash that like button if you don't mind. Write me a review if you haven't already. And thank you so much. I will see you on the next episode.